In this video, we are going to compare the results of saving your money against investing your money for a period of time. Now, you've worked hard, you've saved your money, you did the responsible thing, you put 10,000 into your bank, into your savings account. Now, fast forward 10 years, you check your balance, it says 10,800 maybe, 11,000. You feel good until you realize something. Your money is actually worth less than when you started because inflation silently eats away at your savings every single year. This is one of the biggest financial mistakes millions of people make. They save money but never invest. And today we're going to break down exactly why investing for the long term can massively outperform savings. How inflation destroys purchasing power, and what would have happened if you invested in one of the investments in the stock market instead of a bank account. Since 2014. By the end of this video, you'll understand why long-term investing is one of the most powerful wealth-building tools available. Now, first we need to understand the enemy. Inflation. Yes, it's the enemy. Inflation is simply the rising cost of goods and services over time. And historically in the UK and US, inflation averages around 2 to 3% per year. That might not sound like much, but over time it compounds. Here's a simple example of inflation averages 3% per year. Then in 10 years, your money loses about 26% of its purchasing power. In 20 years, it loses almost 45%. In other words, £10 a day may only buy you £7 to £8 worth of goods in 10 to 15 years. Now, here's the scary part. Most bank savings accounts do not beat inflation. Research from Finder found that the average UK savings account lost £2,718 in real value between 2014 and 2024 because interest rates were lower than inflation. That means savers were actually losing money every year in real terms. And in recent years, it has been even worse. Inflation peaked at around 11% in the UK in 2022, the highest in over 40 years. Meanwhile, many banks were offering 1 to 2% savings rates. So even though your account balance goes up, your purchasing power goes down. And this is exactly why long-term investing becomes so important. Now, let's talk about the alternative. Investing in the stock market. More specifically, long-term passive investing. This is one of the most popular strategies over the past 10 years. We've seen one of the investments in the stock market returning roughly 14% per year on average. Even over much longer time periods, the average annual return has been around 8 to 10%, including dividends. And this is where things start to get really interesting, because when your money grows at 8 to 10% annually, something magical happens. Compounding. Yes, compounding means your money begins earning returns on the returns it already made. And over 10 to 15 years, this can dramatically increase your wealth. Let's run a simple experiment. Imagine two people in 2014 both have $10,000, let's say. Person A puts it into a bank savings account. Person B invests it in a stock market. First, let's look at the stock market. In 2014, one of the best investments gained around 13 to 14%, followed by a small gain of around 1.25% in 2015. But over the following decade, the market produced strong returns. Some examples are in 2019, around 31% return, and in 2023, 26%, and 2024, 24%. The overall trend of growth. Now let's compare outcomes. If you invested $10,000 in the stock market in 2014, it would be worth roughly $35,000 to $40,000 today, depending on reinvested dividends. That's roughly 3 to 4x growth in about a decade. Now compare that to a savings account. Average savings rates in the UK and the US over the last decade have often been below 2 to 3%. At 2% annual interest, $10,000 becomes about $12,200 after 10 years. Now adjust for inflation. Your purchasing power might actually be closer to $9,000 or less, meaning saving protected your money from disappearing, but investing multiplied it. Here's where long-term investing really shines. Time reduces risk. A lot of people avoid the stock market because they hear things like stocks are risky, and in the short term, that's true. The stock market can go down in any given year, but zoom out. Over a longer period, the probability of gains increases dramatically. Research shows investment trusts have beaten cash savings in 100% of 10-year periods since 1996. So, the longer your time horizon, the more likely investing beats saving. This is why experts often recommend a longer-term investment horizon for stock market investing, because short-term volatility becomes much less important. Despite all this evidence, millions of people still keep most of their money in savings accounts. Now, why is that? There are three big reasons. First, fear of losing money. The stock market goes up and down, and people hate seeing their investments fall temporarily. Second, lack of financial education. Many people are never taught how investing works, so they default to what feels safest, and that's saving. Now, third is short-term thinking, only looking at only 1 to 3 years down the road. But if you're thinking more long-term, the equation changes dramatically, because compounding becomes your biggest ally with investing in the stock market. Let's imagine investing £500 per month for 15 years. If the market returned 8% annually, you could end up with roughly 170,000 plus, even though you only invested a capital of 90,000. The difference is the power of compounding, and if the return was closer to the recent decade average of 10 to 14%, the results could be even higher. The same money sitting in a low interest savings account might barely keep up with inflation. Saving money is important. You should absolutely keep an emergency fund in cash, but for long-term wealth building, saving alone is rarely enough. History shows that investing over 10 to 15 years has consistently outperformed cash savings and beaten inflation. And the earlier you start, the more powerful compounding becomes. So, the real question is not, should you invest? The real question is, how long are you willing to let your money work for you? Subscribe and drop a comment if you are sticking to your savings or if you're going to invest for the long term. I look forward to seeing you in our next video.